months, yes, and I think that's something that markets have really been frustrated trying to get into this short dollar trade since the start of the year, and it just hasn't worked. And I think this is sort of understanding where we are at the cycle. We still, for much of this year, have seen dollar exceptionalism. It's been exceptional U.S. fiscal policy that's run ahead of the other markets, and that has helped to fuel kind of more dollar buying of what we're sitting. There still is this nascent kind of positioning to try and be overweight foreign equities over U.S. equities, and that should be giving some bit of push in the dollar. But if you try and break the markets out right now, I really break them into sort of the risks area and sort of the policy rate area. And the dollar overall, the euro in particular, is very much in that rate side of things. It's very much a real rates trade. And so the reason we started to see the dollar weaken again over the last month or so was very much tied to this move that we had in moving U.S. real rates lower again. But now that we're back near the lows, now that we're starting to see the Fed potentially talk about tapering, now that the market's putting that in, if we see U.S. real rates push higher, you will see the dollar strengthen. There just isn't much way around that, because that risk flow of what's going on in equities and credit markets and break evens and copper doesn't have the same influence at this point into the dollar overall. So I think if you're trying to trade euro, you are simply trading U.S. real rates right now.
Well, you know what else is a U.S. real rate trade? Gold. And I think yesterday was a very good example where there was no asset class to hide in apart from gold. Gold was the only asset class that ended the day, well, marginally positive, but at least still positive on a day of huge declines everywhere. How are you thinking about gold, especially given the volatility that we've seen of late? Are you upping your allocation? Do you think that it is something that investors should think about holding going into the second half of the year with, again, some of those risks that could arise from tapering talks or the move higher in interest rate real yields in the U.S.?
Absolutely. I think gold had a phenomenal run up kind of, over the course, in last year. And when that reversed, I think it scared a few investors off. You didn't have the same kind of sort of inflows back into there as you might, given what was going on overall. But if you look at that real rates trade, I think the dollar overall or euro right here is relatively rich. Gold is relatively cheap. So when you're trying to kind of think about that positioning, gold is definitely one that still has catch-up potential. Even if we see a flat line in that overall real rates trade, there's still catch up to be made on gold. So as we're getting into 1900 even above, I think that's still an area that does have scope to, given what we're seeing with policy rates, given what we're seeing with inflation dynamics, and just overall under positioning on that side of things, that's certainly a catch up trade that can have more legs.